The United States government insists it has never defaulted. Treasury officials repeat this mantra like a prayer. Financial textbooks echo it. Politicians stake their credibility on it. And all of them are lying, or at least choosing a very convenient definition of default. Because in April 1979, the most powerful nation on earth failed to pay its debts on time. Not because it couldn't, but because of something far more disturbing: bureaucratic chaos, technological incompetence, and political brinksmanship. If that sounds familiar, it should. Because the machinery that failed then is essentially the same machinery holding your financial future together right now. The story you're about to hear isn't taught in economics classes. It's barely mentioned in history books. But it reveals a truth that should terrify anyone who thinks American debt is the safest bet in the world. Safety is an illusion maintained by reputation, and reputation can crack faster than you think. Let's go back to early 1979. Congress had just raised the debt ceiling after months of political theater, a preview of the gridlock that would become routine decades later. Treasury Secretary Michael Blumenthal assured the world that everything was under control. Payments would go out on time. America's credibility was intact. But behind the scenes, the Treasury's back-office systems were drowning. They were processing an unprecedented volume of transactions, and the technology primitive, even by 1970s standards, couldn't keep up. Then came the mistakes. Small Treasury bills, the kind held by ordinary investors, started maturing, and the checks didn't arrive. At first, it seemed like a glitch. A few delayed payments, maybe a week late, nothing serious. But as April wore on, the delays multiplied. Thousands of investors, individuals, not institutions, found themselves holding worthless paper. They had lent money to the U.S. government in good faith, and when the time came to be repaid, the Treasury simply shrugged. The excuse? Workload? The reality? The most powerful financial system in the world had defaulted because it couldn't handle basic bookkeeping. Now, Treasury officials will tell you this wasn't a real default. They'll say it was a technical glitch, a temporary delay, an administrative hiccup. But ask yourself this: if you failed to pay your mortgage because you were too busy, would your bank call it a hiccup? If a corporation missed bond payments due to computer problems, would Wall Street shrug it off? The answer is no. Default is default. The reason doesn't matter. What matters is that creditors didn't get paid when promised. And in 1979, for the first time in modern history, U.S. creditors didn't get paid. Here's where it gets interesting. Most people never heard about this because the financial media barely covered it. The Treasury downplayed it. Wall Street didn't panic. Why? Because in 1979, American credibility was still so overwhelming that even a default couldn't shake global faith. The dollar was strong. Inflation was a problem, but not a crisis. The Soviet Union loomed, and investors had nowhere else to park their money. So the world collectively decided to pretend it didn't happen. But the bond market didn't forget. Economists later studied the fallout, and they found something chilling. After the 1979 default, interest rates on Treasury bills rose, not dramatically, but measurably. Investors demanded a premium, a penalty, for the risk that America might screw up again. That premium has been estimated at around 60 basis points or 0.6%. It doesn't sound like much until you realize that even a tiny increase in borrowing costs, applied to trillions of dollars in debt, compounds into staggering sums. The 1979 default, dismissed as trivial, cost taxpayers billions over the following decades. And it set a precedent. The U.S. government could fail to pay, and the world would tolerate it barely. Fast forward to 2011, and the lesson became brutally clear. Congress, locked in a political standoff over the debt ceiling, brought the country to the brink of default. Not a technical default this time, but a deliberate one. Republican and Democratic leaders played chicken with the global economy, each side betting the other would blink first. Standard & Poor's, watching this circus, did something unprecedented. They downgraded U.S. debt from a AAA to AA+. For the first time in history, American government bonds were no longer considered risk-free. The reaction was immediate. Stock markets plunged. The Dow dropped hundreds of points in a single day. Borrowing costs for the government increased. But here's the twist loyal viewers will appreciate. Treasury bond prices actually rose. Investors, terrified by the chaos, fled into the very asset that had just been downgraded. It was a paradox that revealed the trap the world is in. There is no alternative to US debt, even when that debt becomes riskier. The dollar's dominance isn't based on trustworthiness anymore, it's based on the lack of options. And yet, the warnings were ignored. In 2013, Congress did it again. Another debt ceiling standoff. Another government shutdown. Another round of brinksmanship that pushed the country within days of default. The Treasury began making contingency plans, deciding which creditors to pay first, which obligations to delay. Social Security checks, military salaries, bond payments, all of it was on the table. The message was clear: when push comes to shove, the government will prioritize bondholders over its own citizens. Protecting Wall Street's confidence matters more than protecting ordinary people. This is an ancient history. It's the blueprint for what's coming. Because the debt ceiling crises of 2011 and 2013 weren't anomalies. They were rehearsals. Every few years, the same theater repeats. Politicians grandstand. Treasury officials issue warnings. Markets wobble. And at the last second, a deal gets made. But each time, the window for action shrinks. The tolerance for risk erodes. The cost of political failure rises. Now let's talk about what a real default would look like today. Not a technical glitch like 1979. Not a close call like 2011, but an actual failure to pay bondholders on time. The first domino would be immediate. Treasury bonds, considered the safest asset on the planet, would become toxic overnight. Every pension fund, every insurance company, every central bank holding U.S. debt would face catastrophic losses. The value of those bonds would plummet, not because America is broke, but because trust would evaporate. The second domino would be the dollar. Right now, the dollar is the world's reserve currency because it's backed by the full faith and credit of the U.S. government. But faith is fragile. A default would send a signal to every country, every corporation, every investor. America's promises are no longer guaranteed. Alternatives would emerge: the euro, even gold and Bitcoin. The transition wouldn't be smooth. It would be chaotic, violent, and wealth-destroying. The third domino would be domestic. Interest rates would spike. Mortgages, car loans, credit cards, all of them tied to Treasury yields, would become more expensive overnight. Borrowing costs for businesses would soar. Layoffs would follow. Recession would follow. And the government, desperate to restore credibility, would have to slash spending or raise taxes. Either way, ordinary Americans would pay the price for a crisis manufactured by political dysfunction. But here's the part that should keep you up at night. A default doesn't have to be intentional. It doesn't even have to be about money. In 1979, the default happened because of incompetence. In 2011, it almost happened because of politics. In the future, it could happen because of cyberattacks, technical failures, or global instability that spirals out of control. The system is more fragile than it appears, held together by confidence, technology, and the assumption that adults are in charge. Question any of those pillars, and the whole structure shakes. So what does history teach us? First, defaults aren't rare, they're routine. From ancient Rome devaluing coins to modern Greece freezing bank accounts, every empire eventually breaks its promises. The US is not exempt, it's just later in the game. Second, the consequences are delayed but inevitable. The 1979 default cost billions over decades. The 2011 downgrade raised borrowing costs permanently. Each crack weakens the foundation, even if the building doesn't collapse immediately. Third, the survivors of every default are never the ones who trusted most. They're the ones who diversified. In 1979, investors who held only treasuries got burned. Those who spread risk across assets stayed whole. In 2011, people who panicked and sold everything lost money. Those who understood the game that the dollar's dominance creates its own safety net made fortunes. The lesson is clear: blind faith is dangerous, but so is blind panic. The real skill is recognizing when the rules are changing and adapting before the crowd does. Fourth, institutions lie. Not maliciously, necessarily, but structurally. Governments insist their debt is safe because admitting otherwise would trigger the very crisis they fear. Banks claim stability because doubt would destroy them. The media repeats official narratives because challenging them requires expertise and courage most lack. The result is a system where everyone knows the truth but no one says it aloud. American debt is not risk-free. It's risk-deferred. And deferral only works until it doesn't. So here's the question you should be asking yourself. What happens when it doesn't? When the political circus turns into a real crisis? When foreign creditors decide the dollar isn't worth the risk? When the next debt ceiling fight doesn't end with a last-minute deal? The answer isn't comforting, but it's knowable. Look at every default in history: Greece, Argentina, Russia, the Confederacy. The people who suffer most are those who believe the promises. The people who survive are those who prepared for the promises to break. Preparation doesn't mean panic. It doesn't mean burying gold in your backyard or betting everything on collapse. It means recognizing that the system you rely on has failed before and will fail again. It means holding assets that don't depend on government credibility: real estate, commodities, foreign currencies, skills that create value regardless of what paper says. It means understanding that your wealth isn't what your bank statement shows. It's what you can protect when the statement stops meaning anything. The 1979 default was forgotten because it was convenient to forget. The 2011 crisis was survived because the world had no choice but to keep playing along. But every failure leaves a scar. Every close call teaches the world that American promises aren't guaranteed. And one day, the audience will stop believing the performance. When that day comes, the only thing that will matter is whether you saw it coming. History doesn't repeat, but it echoes. And right now, if you're listening closely, you can hear the echo of 1979, of 2011, of every default that came before. The question isn't whether the United States will default again. It's whether you'll be ready when it does. Because this time the world might not be so forgiving. And your government definitely won't save you. If this changed how you see the system, hit subscribe. The cracks are already forming. I'll show you where to look next.